Number one, what do you make of the sell-off? Number two, to my point on the 10-year yield, it doesn't look like a fear-based trade. We're not seeing buyers come running into bonds, come running into gold. What's your macro take on today and yesterday's big moves?
Well, my macro take is that the economy is absolutely recovering. You saw the JOLTS numbers today, up 40% year over year. The NFIB, the best number since 2020 of November. We're reopening more states. That's leading to better growth. We have ample liquidity. That's leading to better GDP growth. That's leading to a little bit more inflation. And I think interest rates actually are starting to creep a little bit higher. We don't want rates to skyrocket higher. So I'm fine with it just kind of creeping over the 160 mark. And I think it's probably headed higher over time. But that combination of better growth, a little more inflation, little higher interest rates, that's the recipe for cyclicals. That's a recipe for value. And that is what we're seeing. We're seeing a major rotation happening at the expense of growth, at the expense of expensive growth, not just tech, but across the board. Anything that's high multiple has certainly re-rated lower. And I think that that's going to continue because the data is continuing to get better. And I think people are still very crowded in these names, in tech, in FANG, in expensive stocks, because that's what has worked over the last several years. In terms of rates overall, I really just, as I said before, I think if you kind of gradually move higher, and it's going higher for the right reasons because growth is better, that's just fine.
Yeah, Josh, I love that what you said. At the expense of expensive, we'll call it the Burberry to Big Lots trade. No offense, I guess, to either of those names. Is this what you're recommending to your clients as well? Is this finally that great rotation that you guys have been talking about on halftime for months now?
Well, I think the rotation is ongoing, and we don't recommend, to be very clear, that people try to capitalize on like these 7-day gyrations from one sector to the next. It really actually can't be done in real life on a consistent basis. It's a recipe for churning and chopping up your own portfolio, paying a lot of taxes for no reason. We are more likely, however, to look at a market like this and say the setup going forward for new money coming in probably is better than it was 2 weeks ago. You've had a blow off top in some of the most obnoxiously aggressive trades happening out there. You have a little bit more humility in the marketplace right now. You've had some great stocks come down 20-25% from their highs, giving you an opportunity that you were begging for just as recently as February and March, when these stocks were going up 1-2% every single day. And you have some great managers, active managers, who you might have felt, all right, it's too late, I missed that train. So if you're somebody that's looked on enviously as Kathy Woods doubled her client's money, well, now she's in a massive drawdown. So if you're still bullish on that theme of investing in innovation, maybe here's a better entry than you were offered. I actually am seeing signs of capitulation. A lot of the technology names that were deeply red on the open are now green on the day. And I'm seeing actually some of the volatility from tech starting to spill over into the industrials and the financials. The home builders are getting whacked today. XHB down 3.7% this morning. That's pretty notable. It's a huge winner. It's up 33% year to date, even with today's sell-off. But you're starting to see some of the volatility move to other sectors. The VIX almost tagged 24 this morning. That's the highest level we've seen in a few weeks. So I think the action's healthy for people who aren't fully invested in the most aggressive trades, and now they have another shot at it. So I think you should be encouraged more than fearful.